Hello friends, today's topic is BEPS Action Plan number 5, which is countering harmful tax practices. In this topic, we will be studying what is the meaning of harmful tax practices, what are the issues therein, what are the OECD recommendations, and the India tax provisions related to BEPS Action Plan number 5. So friends, BEPS Action Plan number 5, which is related to harmful tax practices which is adopted by a particular country. Let's say in an example that we previously have taken, wherein dividend income was exempt in the hands of a US company. Let's say this is a sort of a preferential treatment provided in respect of exemption of dividend income. Generally, the tax rate in that particular country is 30%. However, for that particular dividend income, it has been provided a preferential treatment, or you can say for a particular industry, there is a preferential treatment wherein the entire dividend is exempt. Then, in such a case, it has to be analyzed in what scenario, in what circumstances a preferential tax treatment has been provided to the exemption of dividend income, or even a concessional in tax rate at 10%, which is less than the normal tax rate applied by that country. Then also there will be questions on why such a preferential treatment. So friends, this could qualify for harmful tax practices, wherein by providing exemption of dividend income, you are indulging in harmful tax practices wherein other countries are affected by such a preferential tax treatment to a domestic company. So in such a scenario, what the BEPS Action Plan number 5 says is to counter this harmful tax practices being followed by respective country, wherein a preferential tax regime is being followed. Another example could be example of Dubai, wherein taxes are not levied at all. So why such a preferential tax regime? If for example say for other class of person they are indulging in tax rate in which they are levying tax on non-resident but not on resident, then why so? Why such a preferential treatment for residents vis-a-vis non-resident? So there will always be counter questions on it. Why such a regime is being followed by a particular country through OECD BEPS Action Plan number 5? This harmful tax practices can be questioned and can be sorted. So this action plan has two parts. First is preferential tax regime, which will be subject to peer review. If any of the member countries are indulging in preferential tax regime, then it will be scrutinized by OECD people, by an authority of OECD, which will be a peer review board. They will analyze the purpose behind the preferential tax regime. If it is for the benefit of the overall economy in the long term, that then it may not be denied, then it may be allowed. Else, if the purpose is baseless, then such a preferential tax regime won't be encouraged and it is supposed to be sorted out by that respective country. And second part is commitment to transparency, commitment of the OECD member countries to be transparent, to exchange information whenever asked about a particular entity on specific tax rulings that have been laid out, that have been held in that country. So let's say US company, US country, US jurisdiction and India jurisdiction. If US jurisdiction wants particular information about a particular entity, wants an information of a particular entity regarding the tax rulings which have been held for that entity in India. So there will be an exchange of information between India and US regarding that particular entity which is resident in US. So meaning of commitment to transparency, commitment to exchanging information whenever asked for. And friends, this is a minimum standard, meaning this is a mandatory standard which has to be adopted by the member countries. On your screen, countering harmful tax practices, one of the four BEPS minimum standards, consists of two parts. One part relates to preferential tax regime, which will be subject to peer review, in which the entire preferential tax regime will be analyzed for the purpose involved, and if it is related to the overall development of the economy. For example, if a developing economy is suggesting certain measures for the safeguard of domestic companies, for the uplifting of the backward areas, then that won't be a preferential treatment. So it all depends upon what are the circumstances which will be reviewed by peer review board. Second part is nothing but commitment to transparency. Also, it is a minimum standard. So friends, OECD has suggested part 1 and part 2 as recommendations for countering harmful tax practices. India chapter, India tax provisions, what India has done regarding the BEPS Action Plan, wherein is there any preferential tax treatment which has been, brought in by India, and if at all, if yes, for such a preferential tax treatment, has there been any peer review or not? So friends, India has introduced section 115 BBF, which is related to taxability of patent, wherein research and development activities, let's say research and development activities are conducted in India and a patent is developed by an Indian entity which is a wholly owned subsidiary of outside India company, which is ACO. Let's take an example. ACO and BCO is a B company is an Indian company which is wholly owned subsidiary of A company which is outside India. Now A company has invested funds in B company. Through that funds, Indian company has developed patent out of research and development activities. Now, one of the conditions of A company was that once the patent is developed, it should be transferred immediately to the A company. A company will take the ownership of the patent once the patent is developed. It will be transferred immediately to A Limited to A company once the patent is developed. So here you can see B company has developed the patent. Ideally, it should have been a property of B company, but it is being transferred to A company, though it has been developed by B company, only because A company has provided funds to B company and there was a condition imposed wherein this will be immediately transferred to A company. Now in this thing, what Indian government did was, if a patent is developed in India and you have incurred research and R&D expenditure, research and development expenditure to the extent of more than 75%, then If such patent is registered in India, royalty income from therein will be taxed at a concessional tax rate of 10%. This was to encourage retain cut start. This was to encourage retaining of this was this provision was brought into place to retain the indigenous development of patent so that companies are encouraged to retain their patent in India, and the royalty income which has been received from it is taxed only at 10%. From the Indian company point of view, it will be like the royalty income that they are receiving is taxed at previously was taxed at, let's take an example, cut start. Let's take an example that it was taxed at 30%. So they used to sell that patent, and accordingly capital gains was taxed. Just an example I am giving. So only capital gains was taxed. Now if you are claiming a royalty income on that patent, you should be holding that patent and earning royalty income, and the tax rate I will reduce it from 30% to 10%. This is a sort of incentive provided by Indian government so that this will encourage the Indian company to hold on to the patent, so that while entering into agreements they make it clear that where research and development expenditure are incurred wholly in India or substantially in India, then we will continue to hold the patent and we will earn the royalty income. So this is how a preferential, a concessional tax regime was brought in by India only to encourage indigenous development of patent as per section 115 BBF, and this is in line with BEPS Action Plan, wherein since since the patent is developed in India, economic activities are taxable in India only. On your screen, section 115 BBF, where a patent is developed and registered in India, then such royalty from such patent shall be taxable at the rate of 10%. For this purpose, developed means at least 75% of the expenditure should be incurred in India by the eligible SSC for the invention of the patent. So section 115 BBF, taxable only at 10% concessional tax rate for the patent which are developed and registered in India, and R&D expenditure should be at least 75%. Purpose is to promote indigenous research and development and making India a global hub for research and development. That's why such an incentive of 10%. It is in line with Nexus approach of BEPS Action 5. Meaning, just to give you background, in an example we took that A company, B company, A company is the holding company and they are taking over the ownership of patent once the patent is developed by Indian company. So here the practices that was followed was intellectual property activity should have been in India, income should have gone to India, but when the patent is registered, taken over by a company as a legal ownership, then the entire income moves out of India and the income is shifted to a company. So to curb these practices, BEPS Action BEPS Action Plan number 5 suggested that the income should be effectively attributed to the Indian company. the income should be attributed effectively to the Indian company as patent was developed in India. This is what BEPS Action Plan number 5 says, and accordingly, this is what is brought into picture through Section 115 BBF also, wherein income is taxed in India, though at concessional rate. In order to provide incentive, income will be taxed in India, where research and development activity are incurred in India. So the same Section 115 BBF is in line with the Nexus approach. This approach requires attribution and taxation of income arising from exploitation of intellectual property in the jurisdiction where substantial research and development activities are undertaken instead of the jurisdiction of legal ownership. So taxability should not be in the jurisdiction where the legal ownership is, but should be in the jurisdiction where research and development activities are substantially carried out. This is nothing but Nexus approach of Action Plan number 5, and this is what Nexus approach meaning there should be nexus correlation between the research and development activities and ultimately where the income has been taxed. And as per the Nexus approach, it is suggested that wherever research and development activities are conducted in that country, income should be attributed and legal ownership should be ignored. Substance over form concept. Legal ownership will be ignored and beneficial owner. In this case, beneficial ownership will be akin to where research and development activities are conducted. In our example, research and development activities were conducted in India, and accordingly, income should be attributed in India. And just to be in line with the BEPS Action Plan, Section 115 BBF was introduced, wherein entities were encouraged to retain the patent in India and a preferential tax treatment, concessional tax rate was introduced at 10%. So, if at all there is a peer review, it will be sorted that the same is in line with BEPS Action Plan number 5, and the same was for the purpose was to encourage the development of patent in India. So friends, Action Plan number 5, countering harmful tax practices. Here the harmful tax practice was a company outside India taking over legal ownership of patent developed in India. And to counter such harmful tax practices, Nexus approach of BEPS Action Plan number 5 has been introduced, wherein wherever the research and development activities are conducted, their income should be attributed, their income should be taxable. And it is one of the minimum standards of BEPS Action Plan. Thank you.